If you are a federal government employee or a military service member, you have access to one of the most powerful tools in the United States, the Thrift Savings Plan, which is known as TSP. But here's the problem. Most people invest in the wrong funds, miss out on compounding growth, or don't know how to maximize their returns. And if you're not optimizing your TSP correctly, you could be leaving hundreds, if not thousands of dollars on the table. And in this video, I'll be breaking down exactly how to invest in your TSP for maximum growth. Whether you're just starting out or looking to supercharge your retirement savings, stay tuned until the end where I will reveal to you the biggest mistake federal employees make that could cost them thousands. Step 5 is the most important and you don't want to skip it. Now I know that investing can feel overwhelming, so many fun options, risk levels, and strategies. You might be wondering, should I go all in on the C fund? Should I play it safe in the G fund? How do I build wealth faster? All of those are great questions and we're gonna get into that. I've researched and studied how top investors maximize their TSP returns while balancing risk. And today, I'm going to break it down to you step by step, no fluff. And by the end of this video, you'll know the best TSP fund allocations for growth, how to adjust your portfolio based on your age and risk tolerance, why the Lifecycle funds, which is known as the L funds, might not be the best choice, and then the single biggest mistake that could cost you 6 figures in retirement. Now, let's get into it. Step 1, understand how each TSP fund works. Before you can maximize your return, you need to know what each fund does. Here's a quick breakdown. G fund, which is a government-backed, low cost, but barely beats inflation. F fund, bonds, which is more riskier than the G fund, but still conservative. C fund, tracks the S&P 500 and is strong long-term growth. S fund, invests in small and mid-cap stocks and has high growth potential. And lastly, the I fund, which is known as the international stock. It adds diversity, but can be volatile. For maximum growth, you can focus on the C and the S fund. But how much should you allocate? That brings us into step number 2. Step 2, best TSP allocation for growth. If you're under 40 and focused on long-term growth, here's an aggressive yet effective TSP allocation. High growth portfolio, high risk, high reward. You're going to put your C fund at 50% and your S fund at 40%. And lastly, your I fund, you're going to put 10%. This setup takes full advantage of market's upside potential, which is key for younger investors. Now, if you're closer to retirement, you'll want to reduce your risk slightly. Here's a balanced allocation for ages 40 through 55. This is a moderate growth portfolio, lower risk, but still has strong returns. You're going to allocate 40% into the C fund, 30% into the S fund, 20% into the I fund, and lastly, 10% in the G fund for stability. For those that are 55 and up and closer to retirement, you should be focusing on preserving your wealth while still getting some growth. Here's a conservative portfolio, and this portfolio is retirement focused. 50% G fund, which is safe guaranteed return, 30% into the C fund, 10% into the S fund, and then another 10% in the I fund. The key is to adjust on your risk tolerance and time horizon. But whatever you do, do not let your money sit in the G fund long term unless you're near retirement. Step 3, should you use the Lifecycle funds, which is known as the L fund? The Lifecycle funds automatically adjust your allocation over time. Sounds great, right? But here's an issue. They're too conservative too soon. They reduce stock exposure too early, limiting growth. But instead, manually managing your TSP allows you to stay aggressive longer and take advantage of high returns. Step 4, rebalance your TSP regularly. I'm sorry, y'all. It's kind of hard for me to say that word. Most people set their TSP allocations once and never touch it again. Big mistake. Markets shift and your portfolio should too. Rebalance every 6 to 12 months to stay aligned with your goals. Buy more stocks when the market is down. This locks in cheaper prices. And lastly, adjust risk as you get closer to retirement. And step 5, as promised, the biggest TSP mistake you should avoid: cashing out your TSP too early. If you withdraw before the age of 59 and a half, you'll pay a 10% early withdrawal penalty, federal and state taxes, and lose decades of compound growth. Instead, you should roll it over into an IRA for more flexibility and tax tax benefits. This one decision can save you hundreds, if not thousands of dollars in retirement. So let's do a quick recap. How to invest your TSP for maximum growth. Step 1, focus on high growth funds like the C, S, and I funds. Step 2, avoid the G fund unless you're near retirement. Step 3, rebalance your portfolio regularly. Step 4, avoid L funds if you want more control. And lastly, do not withdraw early, roll over, and stay. Which TSP strategy are you using right now? Drop it in the comment section down below. I would love to hear from you. If you found this video helpful, please hit that like button, hit that subscribe button for more financial tips. And that's it for now. I'll see you on the next one. Peace.